Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today, we are diving into a Form 8K filing, and trust me, it's a lot more exciting than it sounds. Think of it as financial speed dating a new agreement formed, a credit line, and well, you will see for yourself. This report is dated February 18th, 2025, and it involves Apollo Debt Solutions BDC, which we will call Apollo Debt for short. Basically, Apollo Debt created a new company. This new company is called Bluejay Funding LLC, and it's a wholly owned subsidiary, which means it's completely owned by Apollo Debt. Think of it as Apollo Debt's financial mini-me. This mini-me is important because it's the key player in a new credit agreement, which is basically a fancy term for a loan agreement. This loan agreement, officially the Bluejay Funding Credit Agreement, involves a few parties. Bluejay Funding as the borrower, Apollo Debt as the collateral manager, and also as an equity investor, a bunch of lenders, and BNP Paribas. BNP Paribas is acting as the administrative agent. That means they are the middleman that manages the process. So what is this all for? Well, Bluejay Funding will use the money to buy assets, mainly corporate loans from Apollo Debt. It's like Apollo Debt is selling some of its stuff to its mini-me, Bluejay Funding, to build up a portfolio of assets. These assets will be used as collateral, which is something pledged as security for repayment of a loan, for a future collateralized loan obligation transaction, also known as the Bluejay Funding Debt Securitization. Think of it as bundling up a bunch of loans and selling them off as securities to investors. Apollo Debt still has an interest in these assets because it owns Bluejay Funding. The Bluejay Funding Credit Agreement lets Bluejay Funding borrow up to $350 million as of February 18, 2025. However, this amount could increase if everyone agrees, especially after the Bluejay Funding Debt Securitization is priced, meaning the final value of the assets is determined. Bluejay Funding can borrow and reborrow money, which is called revolving loans, for 2 years after February 18, 2025, unless the agreement is terminated sooner. The whole thing matures, which means payment is due 4 years after February 18, 2025. This is called the Bluejay Funding Warehouse Final Maturity Date. Before that final date, any money Bluejay Funding gets from its assets, like interest or fees, needs to go towards paying fees, expenses, and interest on what it borrowed. Then, on the Bluejay Funding Warehouse Final Maturity Date, Bluejay Funding has to pay off everything it owes. Any leftover money either goes back to Apollo Debt or is used according to the Bluejay Funding Debt Securitization documents. The Bluejay Funding Credit Agreement allows Bluejay Funding to borrow money in US dollars. The interest on these borrowings is based on the 3-month Secured Overnight Financing Rate, or Term SOFR, plus a margin. Specifically, the interest rate is Term SOFR plus 1.65% for the first 24 months. Then it jumps to Term SOFR plus 2.65% after those 24 months. The agreement also has standard rules called covenants that limit what Bluejay Funding can do, like how much more debt it can take on. The lenders are secured by a first priority security interest. This means they get first dibs on Bluejay Funding's assets. Bluejay Funding pledged its assets to the administrative agent for the benefit of the secured parties, as per the credit agreement. This is important. These assets are not available to pay the debts of Apollo Debt. So if Apollo Debt runs into trouble, these particular assets are safe with Bluejay Funding under this arrangement. There's also a warehouse collateral management agreement. This agreement says that Apollo Debt will manage Bluejay Funding's assets. Apollo Debt is not getting paid a fee for this, and the reason they are doing this is to help with the Bluejay Funding Debt Securitization, the bundle up and sell off part. Finally, there's a loan sale and contribution agreement called the Loan Sale Agreement. This agreement says that Apollo Debt sold some of its loans to Bluejay Funding in return for a payment. Because of this sale, Bluejay Funding now owns all the ownership interest in those loans. In summary, this Form 8K is reporting a new credit agreement and related transactions that involve Apollo Debt Solutions BDC. Apollo Debt created a subsidiary, Bluejay Funding, which entered into a loan agreement to buy assets from Apollo Debt. These assets will be used as collateral for a future securitization. Apollo Debt retains some interest through ownership of Bluejay Funding. Now, let's zoom out a bit and think about what all this means. Apollo Debt has essentially created a financing vehicle, Bluejay Funding, to manage and securitize some of its loan assets. This could free up capital for Apollo Debt. By selling loans to Blue Jay Funding, Apollo Debt gets cash that it can then use for other investments or to pay down debt. It might improve financial metrics. By moving these assets and liabilities off its balance sheet, Apollo Debt could potentially improve its debt-to-equity ratio or other key financial metrics. Also, there is a risk. Securitization can be complex. If the underlying loans perform poorly, it could negatively impact both Blue Jay Funding and, indirectly, Apollo Debt. I would say overall, it seems like a calculated move to optimize its balance sheet and potentially generate additional revenue through securitization. The success of this strategy will depend on the quality of the underlying loan assets and the overall market conditions for securitized products. Thanks for watching. If you found this helpful, please subscribe, like, and comment.